I'm Kara Murphy, and this is Money with Murphy. For many parts of the country, we're headed into the dog days of summer, filled with ice cream and outdoor movies and trips to the lake. It's also a time when many fund managers and traders head to the Hamptons, leading to much lower trading volumes than normal. Despite this propensity for vacations, the market is still open and can be subject to large price swings on low trading volumes. In this quiet time, we're focused on a few important events: the Federal Reserve's Jackson Hole Symposium, corporate earnings, and inflation data. First, Jackson Hole. Later this week, officials at the Federal Reserve will host government officials, academics, and investors at its Jackson Hole Economic Symposium. Don't be swayed by the beautiful surroundings to thinking this is a vacation in disguise. Fed officials use this forum to communicate important policy changes to the public. Past events have covered topics such as monetary policy post the fall of the USSR and housing on the eve of the global financial crisis. Last year, the symposium was shifted to virtual at the last minute due to renewed COVID fears, which also prompted the Fed to soften monetary policy that in turn helped buoy markets through year-end. So what's the focus this year? Constraints on the economy and policy. Think things like supply chain disruptions and surging demand, all born from the COVID economy, which have thrown a wrench in traditional monetary policy. Just last week, Fed officials hinted that they would continue to raise interest rates, and stocks retreated. So we'll be particularly focused on any hint the Fed could be being more or less aggressive in slowing inflation. Second, we're focused on the final few earnings reports for the second quarter. About 95% of all companies in the S&P 500 have reported earnings, and there are a few notable trends. Overall earnings grew almost 9% year over year, with 78% of all companies beating estimates. Those are very healthy numbers. But most of these earnings gains came from energy companies, helped by higher oil and gas prices. By contrast, firms in commercial services, financials, consumer discretionary saw substantial declines relative to last year. A handful of notable companies have yet to report earnings and hail from a range of sectors, everything from work-at-home technologies to retailers and large banks. Third, over the next week or so, we'll get a series of important economic data points, the most important of which is Personal Consumption Expenditures Price Index, otherwise known as PCE. This is a critical, if less known, way of measuring inflation, focusing on those products and services most purchased by U.S. consumers. Recall that 2 weeks ago, we got another release of another better-known inflation index, CPI, which provided our first hint that inflation was in fact beginning to slow. So when PCE is released next Friday, we'll be watching closely for further confirmation that increases are slowing. We'll continue to monitor these and other developments, and until next time, invest wisely and live richly.